So chapter 5 talks about cost, volume, profit. We're going to be looking at how this works as a method. So we're going to start with some basic explanations of concepts in Learning Objective 1 today. Um, and first, it starts with sort of an understanding of what we're doing. We're really kind of looking at a cost behavior analysis with CVP. And so what we look at is, specific costs should change as the level of business activity changes. Okay. Um, and very specifically, we will see in this chapter that some costs that we incur will change as activity level changes. Strangely enough, some will remain the same. Other costs will remain the same. This type of analysis really helps managers make plans and decide and help in their decision-making abilities. Um, and again, the focus on cost behavior analysis here are looking at some key business activities that you've already been sort of introduced to. Okay. So activity levels that you already kind of know a little bit about could be in terms of sales. So in a retail store, if a company has more and more sales, what are the costs that are responding to that? What's going up? What's remaining the same? For a trucking company that's driving, number of miles, what costs are specifically responding to that, and what costs are actually the same. For a hotel, how many rooms they have for occupancy. Again, there's certain costs that are going to change with more and more and more hotel rooms being occupied. And believe it or not, there's some costs that are going to stay the same. Right. And, classes, dance classes at a dance studio, again, as more and more and more classes get taught, some costs are going to change in response to that. Other costs are going to be the same. Many companies use a lot of different measurements. Um, and so, to track all of this, when they do track it, they actually usually call it sort of like an index, an activity index or a volume index, because that index helps them identify the activities that are causing the changes in the cost structure. And we're going to be learning about 3 different types of costs that they're looking at. First are variable costs. Second are the fixed costs. And then we actually have something called mixed costs that you'll be introduced to today. So don't get too mixed up about it and don't get so fixated on it because life is variable. Okay, I'm going to stop right there. So here we go. Some variable costs, right? So they vary based on the change in activity levels. So if activity level is increasing 10%, you would expect your variable costs also would increase 10%. The same is true in the opposite direction. If your activity level decreases by 25%, you would expect your variable costs to also decrease by 25%. Variable costs are interesting because they remain the same on a per unit basis, that you'll see, regardless of whether activity is going up or down. Per unit, the cost is the same. So what do they mean by that? Here's an illustration. Here's Damon Company. They manufacture tablets that have a $10 camera as part of the tablet. All right. So as Damon manufactures each tablet, right, the total cost of the cameras are going to increase by $10 for every unit. So as you see in the graph here, the illustration, the more and more computers they produce, right, the higher and higher the cost that they'll incur to put cameras in it, right? So the cost of cameras are $20,000 if they produce 2,000 tablets, but the cost of cameras is $100,000 if they produce 10,000 tablets. And so again, the variable costs in total, this is in total, will rise with activity or decrease with activity the exact same. However, it doesn't take away the fact that each tablet has a camera that's worth 10 bucks. So regardless how many they produce, they're still going to put a $10 camera in the tablet, regardless how many. So in this case, the unit per unit, still 10 bucks per unit, right? Because every single unit, every single tablet is going to have a $10 camera and no more than a $10 camera. So in that sense, these costs are the same per unit, but they will fluctuate in total with all the units. More units, more cost, less units, less cost. Okay, and that's actually what this illustration shows, right? The total costs are totally correlated, right? The more produced, the higher the cost. The less produced, the smaller the cost. So it goes up and down with this. However, the cost for each camera in each unit is stable, 10 bucks per camera per unit, regardless. So again, we're looking at total versus per unit, two different parts of the slide here. For fixed costs are very interesting because you're going to pay the same rent regardless how many tablets you produce, right? So in essence, fixed costs remain the same regardless on how much you're producing, okay? However, when you look at fixed costs per unit, clearly the more units you have completed, your cost per unit for fixed costs is actually smaller, goes down. So it's an inverse relationship, as you'll see. Okay. So again, fixed costs like property taxes, insurance, rent, depreciation is fixed for the month, right? It doesn't really matter. Those costs in total, those costs are the same. Okay, regardless of the activity level, those costs are the same. However, when you compare those costs per unit in activity, that's where you're going to see that inverse relationship. Okay. So here we have, whoops, I'm sorry, clicked the wrong, got clicky fingers today. So here they lease a production facility for $10,000 per month. Okay, so that's a fixed cost. That $10,000 per month is going to remain the same regardless how many tablets Damon Company produces, right? So in that sense, the total fixed cost is the same regardless how many computers they produce. Right? However, as you look on a per unit basis, right? The more they produce, right? The fixed costs per unit go down. It's an inverse relationship. So for example, right, at 2,000 units, they're spending $10,000 for the month on rent. If they only produce 2,000 units, well, that means that each tablet costs $5 a piece in that fixed cost per month, because you've got 2,000 units divided into the $10,000 rent, $5 per unit, literally. However, if you're producing 10,000 units and you're spending $10,000 on rent, each unit is going to be roughly $1 per unit in rent or fixed cost in that regard. So that's the inverse relationship here. The more units you produce, the lower the cost per unit, The less units you produce, the higher the cost per unit. Um, and that's important to sort of see that relationship. And here's a lovely graphic. I think you should, if this was a nice little painting, you should buy it, put it in your living room. Okay. So variable costs basically they vary in total, directly and proportionately with activity level, but they remain the same per unit of activity, right? That was the earlier piece that we looked at. So the correct answer here is D. I like the story. It's a nice little story. Gardens in the sky. It sounds really romantic, you know. Nah, just joking. So here they have an interesting story here because the food production is going to need to increase. And of course, the earth is running out of, we have a lot more people and a lot less land to grow food. And so, where we're going to get all that food. Well, that's very interesting because they have a New York company called Bright Farms that are building basically urban greenhouses, right? And so it's very interesting that they're doing this. Okay, so how do the numbers work? Well, some variable costs will be reduced. So, example, they won't have to use much, in terms of pesticides or herbicides or shipping or water. Those costs would drop significantly since it's in a greenhouse, basically. The soil erosion wouldn't be an issue since everything is grown hydroponically. So that's, I don't know if you've seen those, plants that grow without soil, basically. Very interesting. They wouldn't need that much land because everything is vertical. However, other costs certainly would be higher because now they're going to need to set up all these buildings. It's their urban greenhouses, right? And so, and it's going to require artificial lighting, which costs pretty good amount of money with that. So basically, is it a pretty good idea? Well, it's challenging for sure, for sure. And we don't know when these things are going to break even. What we do know is there's a lot of rooftop greenhouses in the city, and these are working out pretty well, pretty well. So, for example, a 15,000 square foot rooftop greenhouse in Brooklyn has produced already 30 tons of vegetables per year, which really makes it sort of a cash cow. They can be literally dancing on their roofs. Okay, how terrific. All right, so here what I wanted to do here is we're going to look at something, a new term called a relevant range. Relevant range, okay? And this is because when you have a factory that can produce these tablets with cameras, I mean, how much of the factory is actually working at the same time? There's no such thing. I mean, hopefully it's not zero, but in very, very rare would it ever be close to 100% of the factory working as well. So there's a range of production levels that exist. Most factories kind of are somewhere between 40% and 80% of capacity. In other words, that's how much of the factory is being used to produce certain goods at any one point in time. So the relationship is not a straight line. It's not a straight line. It depends on the level of activity. So what they've come up with is to show a relevant range. The actual relationship is curvilinear. Okay. And so this is a very interesting issue, and you probably have heard it before in math, but this is what a curvilinear relationship looks like, right? So again, this is between 0% of the factory running and 100% of the factory running. Normally speaking, most of the time, factories are running sort of in between this 40 to 80% range. That's in the country. Most of the factories are in that range. But as you see, as for variable costs, as there's more and more activity, this is not a straight line. This is kind of curved, right? And so that's where this sort of comes in. Fixed costs they're not linear either. It's not like they're a straight line one way or the other. At a lower activity level, fixed costs would be at this level. However, as more and more activity happens, the fixed costs would continually increase to a point where they would flatten out. That makes it very interesting because you have some variable costs that are curvilinear and some fixed costs that are not linear at all. And so what we have is what we call really a mixed cost, as you'll see in a moment. Okay, so this is the relevant range. And what I was telling you about, most companies operate their manufacturing plants in some type of relevant range. Very rarely does it drop below 40, very rarely does it get above 80. That's the relevant range in which they can expect to operate. Okay. So the relevant range, again, that range of which they expect to operate during a particular year. Remember, all these costs are estimated, so they have to also estimate their relevant range. So what about costs that have somewhat of their mix? They have both a variable element to them and a fixed element to them. They are not proportional. So how do you deal with that? Well, here's a graphic of what a mixed cost would be. It's partial fixed cost and partial variable cost. And so again, as for example, if this was a truck and this was the number of miles that it was being driven, the more and more miles it had driven, it's going to have a fixed cost to that. But actually, there's some variable costs that are going to increase. The more miles that it is driven, the more of this variable cost element will become an issue. And so that's basically an example of a mixed cost. And your objective ends with really understanding what these costs are. These are the total costs for Helena company at 10,000 units and 20,000 units. And your job is to see if you can identify which one of these costs are variable, which ones are fixed, and which ones are mixed, okay? So the very first one we see here, direct materials, at 10,000 units, we need $20,000 of direct materials. At 20,000 units, we need 40,000. Now this sounds like it's pretty straightforward, right? It's $2 of direct materials per unit here, and it's $2 direct materials per unit here as well. And so that would end up being a variable cost because the cost per unit is the same. Okay, that's important. Maintenance here, if we did 10,000 units of production, we would spend 8,000 on maintenance. If we went to 20,000 units, we would need to cough up a little bit more. This is a sample of a mixed. Oh, sorry. This is a sample of a mixed. There's no real direct relationship between the two. It's just that at higher production, it's just a little bit more, right? Not linear, not something you can actually point to directly. And so this is going to be a mixed cost. For your direct labor, as the arrow earlier had hinted, we need $17,000 to produce 10,000. We produce twice as much, it costs twice as much. So the cost per unit is going to be equal, okay? So that's also where a variable cost is. Indirect materials, in this case, we need 1,000 for 10,000 units. We need 2,000 for 20,000 units. In this case, this is going to be another variable cost as a cost per unit that's equal. And that's what per unit, that's what we look at for variable. What about depreciation? Depreciation is $4,000, whether we make 10,000 units or 20,000 units. Well, that's a fixed cost. That's a fixed cost um, because it stays the same regardless. Right? Of course, the unit, if we did it per unit, it's less, right? It's more per unit if we only build 10,000 units and we spent $4,000. However, if we spent $4,000 and made 20,000 units, our cost would be lower. And so that's identifying as a fixed cost as well. Utilities run at $3,000 if we make 10,000 units. If we make more, it goes up, but not equally. So this is going to be a mixed cost. And your rent is equal, which makes it a fixed cost, right? So this is the terminology and understanding you need to get from this particular part of the chapter. Okay, any questions? I'll take a quick break here.